What are digital assets and how are they shifting the financial landscape? I'm Mike Loder. Crypto Corner starts right now. Hello everyone and welcome back to Crypto Corner, presented by the team at BTC Markets, where each episode we go about detailing those ever-changing crypto market trends. For more on this, I'm going to get Carolyn Bowler, CEO of BTC Markets, to take it away.
Hello and welcome to the latest Crypto Corner. Joining me today is Jamie Coutts, who is the former Chief Crypto Analyst at Bloomberg Intelligence and now is the Chief Crypto Analyst at Real Vision. Jamie, thank you so much for coming along and joining us today.
Hey, thanks very much for having me, Carolyn.
The first question I want to open with is around how should people think about crypto and Bitcoin more in particular? Is this a new asset class? And if so, what are the implications?
Yeah, look, I mean, 2009 was the birth of a brand new asset class. Bitcoin was a technology that gave sort of birth to further developments within blockchain technologies. I mean, Bitcoin started as this sort of trustless monetary network with an asset that has a fixed supply that's completely open to anyone. It was the start of really digital property rights, something that the internet desperately needed at the time. And it's been a breakthrough innovation ever since. There's 100 million people roughly that own Bitcoin, and it's been picked up and adopted in the underdeveloped regions of the world where, access to financial rails is either restricted or completely non-existent. And so, from there, we've seen the development on blockchains of smart contract capabilities, which has increased the functionality so you can do a lot more than just transfer an asset or a currency online. So, when I'm talking to institutional investors and traditional players, I think the thing that sort of strikes me when we're talking about whether this whole ecosystem is an asset class, it's really a question of, it's a generational issue and it's an educational challenge as well, because the frameworks that older people use for assets are usually based on the question as to whether the asset in question or the instrument in question produces a cash flow like a bond does or like a stock does with a dividend, or whether it's some sort of capital or commodity good that actually has, it derives a productive value, has utility and also some degree of scarcity. And so, the one thing that you can always make the point on when you're talking to someone and trying to explain this is that there's a whole other type of asset which we all recognize as being true, right? Intangible assets. And so if you think about like software, no one would argue that software is an asset. The largest companies in the world today are software companies. Mm-hmm. The market capitalization of Google and Apple is around $4 trillion. That's a GDP of some small countries. So, the whole point about intangibles and that being an asset class is already settled. The issue here is, and that what people struggle with is that crypto or blockchains are decentralized in nature, and that's hard for people to understand, but they are really the antithesis of traditional software companies, but they are essentially software. And so that's where the opportunity sort of lies, because you've got an asset class which has grown from nothing to 2.5 trillion in very short order, because people realize there's value in operating in these decentralized networks, these decentralized ecosystems, rather than these online feudal systems where 99% of the value accrues to digital monopolies. This other alternative system allows you to basically stake, be part of the network and receive a cash flow or receive a return stream for that. And depending on the network, it also embodies the properties of a commodity. So that is how we should sort of be talking about it. And of course, we don't need much more convincing, or people don't need much more convincing now that, Wall Street turned up this year and decided that, yes, they want to be part of it. And I think that for a lot of people who perhaps weren't prepared to do the work, or were just simply waiting for the authorities or, large Wall Street players to come along and tap them on the shoulder, say, hey, this technology is here to stay, it's going to be big, and we're here to hold your hand.
Thank you so much for that. And I think those of us who are in the cryptocurrency industry certainly would be nodding away furiously with a lot of your points. And if I may just with that take a quote of yours where gold is the central banker's money and Bitcoin is the people's money. It's a fantastic quote. And I think it really kind of puts across that juxtaposition between traditional and the new economy, as you were talking about there. But what does that mean then for asset allocation for not just individuals, but for the financial services industry as a whole?
Yeah, well, we're starting to see the impact of, we're not starting to see the impact of what the governments have been doing in terms of increasing the sovereign debt burden for really the past 15 years has had a massive impact on markets and asset class performance. And the returns or the performance we've seen in gold recently, I think, is just a reflection of the fact that there's a musical chairs, or there's a change in the power base happening geopolitically. Central banks are accumulating or remonetizing gold as part of their reserves because they understand that they can't rely on the US dollar, that the US debt situation is now really a spiral. And, for people who are looking at the world where sovereign debt is growing in order just to basically pay off the last round of sovereign debt issuance interest payments, that the debasement is getting worse and worse. And for people, they're clearly making their choice. The market has spoken. Bitcoin is people's money, but when it comes to the central banks, they're not there yet in terms of that kind of thinking. They still see value in holding gold, which is, a scarce store of value asset that's proven itself over the millennia. And so you're starting to see, both of these assets perform extremely well. I mean, gold's breaking out. It's been sort of in a sideways range for about 10 years. But look, over most epochs, if you look at the performance of gold, it has outperformed the level of debasement. And there's very few assets that do that. The only other assets that have over the last 10 to 20 years has been Bitcoin, has been digital assets, and has been technology stocks. So the implications are absolutely huge for the whole financial markets, geopolitics, corporate strategy. Maybe just to sort of put a little bit of context around that too, I think, the whole world revolves, the financial advisory world revolves around the model portfolio template. And so when you think about how the 60-40 portfolio has probably allocated tens of trillions of capital over 20 or 30 years as it sort of became the benchmark allocation. And you think about going forward, is that 40% allocation to bonds, especially sovereign, government bonds that are debasing their currency because their debt to GDP are beyond manageable levels, then you start to sort of see a new paradigm where Bitcoin, and to a lesser degree, because digital assets, because I do put these things in different buckets. Bitcoin, as I said, is people's money. It's a fantastic monetary hedge. It's got unique properties. Digital asset is really a large technology play in my mind. But if Bitcoin starts to eat away at the allocation of fixed income rather than the allocation towards equity, which I think is how people think about it, but I think it should be reversed. Bitcoin should really be the allocation away from fixed income as the debasement really accelerates. Then it has massive implications for the value of the asset, and also for the utility of the asset. So we're really at the start of this whole shift, but you can see it already playing out. Like Fidelity and BlackRock, the issuers of the US ETFs, they've already started to recommend in their model portfolios, their multi-asset portfolios, that Bitcoin takes a 1 to 2% allocation. These products are really at the start of massive growth. And if the investment advisory community, starts to look at, and they do obviously, because they're kind of like in the network of these massive financial institutions, they pretty much follow those recommendations, then you can see, Bitcoin ending up into the portfolios of a lot of individuals over the next couple of years.
And I think that's true too. One of the recent statistics I saw was that the alternative asset class in 21, I think, was valued at $13 trillion. And when you think about the size of the cryptocurrency industry at the moment is many magnitudes smaller than that. So even if you just look at it as an alternative asset, there is so much growth potential to come, from looking at those kind of more traditional products and where the allocations lie. But I didn't realize that about that 1%. That is a significant number when you kind of look at it from the macro point of view. That is a significant number. I also hadn't heard that comparison to moving into fixed income. That's certainly an interesting perspective to have. So then when we do talk about adoption and what the adoption is going to look like, who is driving it? What's the next stage on this?
I think for this question, you need to start putting some numbers around it, because I think at the moment, people are looking at the crypto ecosystem, but they're looking at it through the narratives at play. But let's actually talk about the numbers behind it. And the number of daily active users that are interacting with blockchains now is around 10 million. And so that number actually doubled from 2021 to 2023. And if we think back and what happened in 2021, 2022, we had, your typical crypto winter or crypto bear market of 70 to 90% drawdowns in most assets. So adoption continued unabated, irrespective of the price action over that period of time. And I think that was, a very telling sign in the end of 2022 that this thing was being adopted irrespective of the speculative element that's obviously embedded in token prices. But if you look at the growth in users, compound annual growth rate from 2014 is sort of between 40 and 50%. So 40 to 50% more users every year. And, that number of daily active users, that is, if you compare that to sort of a traditional company. So let's take PayPal. So PayPal has 430 million active accounts. So it doesn't really give you a daily or a monthly active user count. But obviously, tons of people have PayPal accounts, but they're not using it every day. They might use it a couple of times a year. So when you really look at the terms of the daily active users, it's a number that's far smaller than that 420 million. And sort of, I think, within a couple of years, blockchains will be on par with PayPal and overtaking it. If you just sort of extrapolate out what those numbers mean and those growth rates mean, based on those growth rates, by 2030, 70 million active users is probably a fair number that we're looking at. And that would probably mean that the number of people who own digital assets has crossed 1 billion. I think we'll cross 1 billion well before that. And the numbers are sort of around 200 to 300 million at the moment, estimates. But I think we actually get to 100 million active users by the end of this decade, believe it or not, because there's network effects here that we haven't thought of. The thing about networks is they drive exponential growth. And so as every new user comes on board, it has an exponential impact on the network and on the value of those assets. And we've got to put it into context. Let's face it, this has happened despite every regulatory hurdle, every bit of negative FUD from the legacy media and from the traditional financial industry that has slowly started to sort of realize the opportunity here.
Yeah,
so
absolutely. Sorry there, if I can sorry to interrupt you, but we just have to wrap up for our time for today. Jamie, thank you so very, very much for joining us, and thank you so much for our audience as well for coming along. Thank you.
You're watching Ticker. We'll have more in just a few minutes.